So you keep on hearing it. $5 trillion in liquidities just flooded into the market. But where exactly is all this money coming from? Who's turning on the faucet? Because it sure isn't stimulus checks this time. Alright, let's break it down. This isn't some made up number, it's real capital flowing into the global system quietly but aggressively. And the reason? The system is showing symptoms of a deeper illness. Cracks are forming, defaults are rising, growth is slowing, debt is suffocating. And the only prescription central bank seems to have is more liquidity. First up, the US Federal Reserve. The signs were flashing red. Regional banks were wobbling. Bonds markets were breaking down. Long-term treasuries were getting dumped so fast it looks like a fire sale. So the Feds brought back the bank term funding program, basically letting banks swap trash collateral for fresh cash at face value. That alone injected over $1 trillion in stealth liquidity quietly behind the scenes. And don't forget the reserve repo facility. Banks are draining it fast, sucking more than $500 back into markets. Why? Because they need liquidity fast. That's more fuels. Total from the Feds, over $1.5 trillion. And here's the real story. They're doing this not because the economy is strong, but because it's on thin ice. Inflation is sticky, debt is unpayable, and rate cuts are coming. So they're prepping the plumbing. Now swing over to China. This one is brutal. The entire real estate empire is collapsing. Ghost city, bankrupt developer, empty mall, debt with no return. And the people banks of China, they're panicking. They slash rates, print hundreds of billions of yuan, and injected liquidities into their banks through MLF, medium terms lending facility, and RRR cuts. That stands for required reserves ratio. They even launched a $112 billion stock market support package to support the market from imploding. Total estimate $500 to $800 billion in liquidity because the symptoms in China is deflation. The economy is slowing. The exports are under pressure, and youth unemployment is spiking. Liquidities is the lifeline. Next, Japan. They've been in a money printing marathon since the 90s, but recently they doubled down. The Banks of Japan is still buying its own government's bonds like there's no tomorrow. They're holding rates near zero while the rest of the world was hiking. Why? Because the economy is aging. Growth is flat. And any rise in borrowing costs could collapse the fiscal structure. There's silent liquidity around $500 billion. And most of that capital, believe it or not, leaks into U.S. assets, tech stocks, treasury, even Bitcoin's ETF. Japan export liquidity like it's export sushi. Europe's not far behind. The ECB is quietly injecting liquidity again after pretending to tighten. The Eurozone is choking on high energy costs, a war on its doorstep, and weak economic growth. France and Germany are flirting with recession. So what does ECB do? They lower rates and reinstate TLTRO, those long-term cheap loans to banks. They also quietly buy bonds to keep the peripheries from breaking. Total liquidity over $1 trillion, and it's not labeled money printing. But when you swap old debt for new money, guess what? It's the same games in disguise. Now here's the part no one talking about. Sovereignty wealth funds and mega institutions. Countries like Saudi Arabia, Norway, Singapore, they're not printing, but they're deploying trillions in store capital. Why? Because cash is melting under inflation and they need yield. They need real assets. They need safe havens. So they're moving hard into US equity, energy, and yes, Bitcoin. Estimate says over $1 trillion has been moved just in the last few months. So when you add it all up, US equals to $1.5 trillion. China up to $800 billion. Japan's $500 billion. Europe $1 trillion. Sovereign and institutional flows $1 trillion. There you go. That's your $5 trillion. But here's the kicker. This isn't free money. This is emergency response. The system is gasping for air. And global leaders are throwing everything they got at the symptoms. Banks instability, real estate's collapse, debt crisis, recession's risk, rising unemployment, geopolitical tension. Liquidity is the band-aid. It's not a cure, but it buys time. And while the war prints, prices of real assets, especially scarce, decentralized assets like Bitcoin, start rising first. Why? Because they're the exit door. They are the assets that central banks cannot dilute. So here's the takeaway. Don't wait for headlines to tell you the system is under stress. Follows the liquidity. It always tells the truth. If you're stacking, guys, you're not crazy. You're just early. If this helped clear things up, hit the like button and subscribe for more deep dives like this. And my friends, don't forget to hold it tight and stack it right. Take care.